So for someone spoken reason, I can't present this in full screen, but I will do my best by presenting it like this. My name is Linus Jakobsson, and I will be presenting the market leader in the Nordics for window and door installations, name called INWIDO. The contents of the presentation are going to be a business overview, introducing with that, followed by a financial review. We'll look at some revenue, margins, earnings, the balance sheet, their free cash flow, and return metrics. We'll look at the ownership, who owns this company. I will provide my subjective valuation, what I think the company is worth. I'll share the risks and a summary of my findings. Starting with the business overview. This is in Swedish because this is a Swedish company. I don't want to focus too much on what's on here, but the last bullet point, that INWIDO is the only pure window and door play on the Stockholm exchange. So pure play window and door company on the Stockholm exchange. Going to their financial targets. INWIDO wants to target a sales of 20 billion Swedish kronor by 2030. We can see that they've had quite decent performance recently, with a continued robust consumer market and a better than expected industry market, contributing to favorable growth. This presentation of theirs was based on the outcome of 2021. 2022 has been more or less similar. They want to reach a profitability target of return on operating capital of more than 15%. I did not know what a return on operating capital was, so I had to Google that up, and I cut it in there. Income from operations after tax, so that would be EBI, so EBIT, but without the interest, divided by operating capital. This return metric was 16.9. Basically return on invested capital, so very good there. In terms of their capital allocation, they divide up about 50% of their net profit out to shareholders. However, as I have circulated there very beautifully, this is to their cash flow and future prospects. They will be taken into consideration. For 2021 and 2022, or for 2022, it was 6.5 kroner. Corresponding to a dividend yield of about 3.5%, if I'm not misspeaking. So what is INWIDO? They're a leading window group in Europe, but clear market leader in the Nordic region, but with a strong presence in the UK and Ireland. They have a net sales of 9.1 billion since last 12 months, counting from Q3 2022. Return on operating capital 17.9. On the previous slide it was 16.9. Approximately 4,900 employees. Who is the management of INWIDO? As we can see here, their CEO is Henrik Hjalmarsson. He has been their CEO since 2019. Not the longest runway, but has had good performance since then, which we'll see in the financials. However, their CFO, their Chief Financial Officer, Peter Velin, he has been here since 2008. We'll also see that Peter Velin has some skin in the game later on in the presentation. They have a clear and proven value creation model. This is taken from their Capital Markets Day. They have 5 elements that are the basis for this value creation model. They have value creating M&A, invest for growth. We will come into their M&A operations a lot more later. Efficiency synergies from sourcing and technology. So as they merge and acquire different smaller players, there are a lot of costs to be cut within that process, which will create value arbitrage, one would say, for INWIDO. Decentralized accountability with business-focused leadership and drive, yada yada. Performance management and KPI structure, driving right behaviors. Capital efficiency and allocation. Buzzwords, buzzwords, buzzwords. But the most interesting here is value creating M&A and invest for growth. This is their performance since IPO in 2014. Sales growth of 85% in total, operating EBITDA growth of over 100%, and EPS growth over 300%. So we can definitely see that there has been some operating leverage, one would say. We've had the EPS growing in a faster pace than sales and EBITDA has. So revenue with taken revenue or revenue growth has fallen down to the bottom line to a greater extent. Summary of 2020 so far. I have two highlights here. Slightly more resistant markets laterally, but gaining more momentum in price and cost differential as material price pressures is relieving. Weaker development for their e-commerce, mainly due to lost momentum after supply chain disturbances. So what is important here to know is to create windows, the process of creating windows to create necessitizes gas to a great extent. So when gas prices go up, so does INWIDO's costs, because they create windows. About 50% of their output, if I'm not of their costs, is gas prices. So don't quote me on that. We'll get into that a bit later. I have a slide for that. But as we can see, as of the 7th of January 2023, that gas prices, they have been falling down, plummeting down, one might say. And this, you can make the argument that, okay, they have compensated for their prices on the upside to the consumer, like their windows are more expensive because their input prices have been more expensive. But now when those are falling, are we seeing improved profitability because of this production price headwind is now becoming a tailwind, but their price to consumer remains the same? Maybe. I don't know, but it's a theory. Sustainable value through sustainable businesses. This is their target, so 20 billion by 2030. 9.1 billion as of the last trailing 12 months, which is a 24% increase year over year. This was a lot of what we got into before, but the capital, so net debt in relation to operating EBITDA, they target this to be under 2.5 times. Today it is at 0.8. Great. It was the net debt in relation to operating EBITDA I wanted to show with this slide. Key shareholder value propositions. I thought that this was interesting to include into this slide deck. Attractive market driven by green transition, because namely about up to a third of households in Sweden, their energy production is lost, or heat is lost to poor window and door isolations. So a green transition where we want to be energy efficient, doors and windows are very important. They have a strong position in core geographies, namely the Nordics being the most established one. Proven track record through economic cycles. We will see this in our financial review later on. Scalable e-commerce platform and potential to drive European consolidation. The last part is very interesting and will be repeating. The market that INWIDO is targeting is very fragmented. A lot of smaller players are in this space and no clear market leader, at least according to my research. I would love to be proven wrong on that, but no, as I can see, no clear market leaders and in a very fragmented market. So this means that as INWIDO, as one of the bigger, more established companies, they can very easily consolidate this market by acquiring these smaller businesses, integrating into their own company, and reduce costs thereafter. And they've had good success with this, as we will see, or as we have seen with this slide that we saw in the beginning, that a lot of their growth is going onto the bottom line. Great. More on the green transition, short-term potential for accelerated growth with current unprecedented European energy prices. And here is what I said earlier. Up to a third of the heat in a house dissipates through windows and doors, with substantial associated extra energy costs. So up to a third can be saved by INWIDO's product, which is quite enticing. It's so enticing that we have a ton of government subsidies, which is a tailwind, as you can see here from my comment. So, for example, the EU 150 billion for better energy efficiency in the 15% worst performing buildings. And then this is a whole table of different government subsidies that will benefit INWIDO. More on their position in core geographies. Market leader in Sweden and Finland, with a strong number 2 position in Denmark. Growing consolidator position in the UK, and a leader in Ireland on wood products. More referring to their door segment there. Strong market position levered in channel and segment optimization, as well for driving market price points. Most importantly from this slide is the first two. Market leader in Sweden and Finland, with a strong position in Denmark and the UK presence. Yes, here I wanted to demonstrate how yes, so they've had a proven track record, so 10 quarters of strength in margins, followed by robust development, unprecedented material inflation. So they've done a very good job at putting their increases in costs onto the consumer. So pricing power, more or less. Strengthen market positions over time, leading to growing market share and hence growth rates higher than the market. This, I think, is what I wanted to highlight with this, followed by, over the past 15 years, sales have varied by more than 110%. However, profit margin has only varied by 4.4 basis points. These profit margins have been lying to in between 8 to 12%, according here to my notes. So they do a very good job at managing their costs, given the macroeconomic environment. More onto their European consolidation plan. As I mentioned earlier, a highly fragmented European window and door industry leaves room for substantial consolidation. They plan to accelerate their M&A activities to deliver 5 to 10% of growth annually. They have not grown or acquired businesses by issuing stock. It's all come out of own pocket and cash flow. And what I like that they're focusing on is positive multiple arbitrage and leverage two-step acquisitions in the case of standalone business. So they're not wanting to acquire just for acquiring sake, but make sure that this is creating value for the company. Here's a 4 slides combined into one, and where they have proven that they are successful and what markets they are wanting to tap into. In case of time, I think I will continue on from here, but you're welcome to pause if you want to read this. Here's on where the synergies are to be found within their M&A strategy. So direct material is typically 50% of revenues. Sourcing savings vary from a few single percentages up to north of 10%, depending on the material type and geography. Typically implemented into 12 months. So when they acquire a business within their niche, they can source or use their own supply chain network to provide that business with the materials necessary, and this reduces cost, or that reduces costs from the acquired business, but whilst maintaining your own costs quite constant. Does that make sense? I think that makes sense. Here they go on to by speaking about how great they are in operational excellence. And so on. I think the sourcing part is the most interesting one, if I recall correctly. I'm kind of doing this on the fly. Yes. But you're welcome to read it. But the sourcing part is the one that I think is most interesting and makes most sense. The others are a lot more look at how strong and good we are as INWIDO, the company, which anyone can say, but the sourcing part is proven. Here is a visualization of their acquisition since 2014. The IPO was in 2014, and as my comments is here, they have done this whilst maintaining margins and actually improving margins, so more on the bottom line. I repeat this, that their growth has resulted in margin expansion and a proven model for operational leverage. This is very enticing to me as an investor. So their key ambitions to grow the business is invest for growth. They are continuing to grow in the e-commerce space with their e-commerce platform. As I mentioned in the beginning, this has been a headwind for them most recently. Operational excellence to drive efficiency and margins. I would give them the benefit of the doubt because this is what they've proved so far. Value creating M&A. So consolidating fragmented markets. Here's a slide of them showing off how energy is on top of the home agenda, that this is a prioritized area, focus for consumers. And showing some statistics there. Their overview of their e-commerce business. I guess we can focus mostly on the challenges that they've had in 2022. So they made 2 large machinery installments in 2022, challenges with the implementation on our largest site in Estonia, and they lost almost 40% of their capacity on the site in Estonia. I have not found to why this was. I have not. Production challenges and lost capacity are key drivers to weaker performance of supply chains. And they're on our way back, and today's capacity is no longer a challenge. So the installment in Estonia is expected to be fully implemented during Q4 2022. So it will be very interesting to see if they have delivered on that expectations, on their expectations here in Q4. I put the question mark here if this is a growth driver for the business or can drive them towards their $20 billion dollar revenue goal in 2030, as their financial target suggests. More so, to some extent, consolidated markets where INWIDO is the clear leader. They've had a very favorable market in general in H1. In Q3, this softened. Before we get into the softened part, they have had very favorable markets for the past 2 years with the COVID boom. Everyone wants to renovate their homes and prioritize their homes, especially with interest rates being so low. Financing for such renovations have been very cheap. This is not the case anymore. So my question is that this Q3 softened activity in Scandinavia, is this the first time of the consumer screaming a bit or softening? Perhaps an indication of what is coming. Scandinavia overview. We can see that the net sales of 5 billion, this corresponds to, or this is the majority of their sales. EBITDA margin of 14.5, 2,320 employees. Here I have circled, I hope you can see, but the blue, as I read here, is the consumer, their consumer markets in Sweden, Denmark, Norway, or sales that are driven by the consumer, whilst yellow is industry. So sales that INWIDO conduct that are to industry is in the yellow. As you can see that their sales are mostly consisted of the consumer, and I have a hard time believing that this strong growth that they've experienced in the past 2 years will remain, with the consumer being such a huge part of their sales. Absolutely, there are government subsidies for driving such growth, but my guess is that we are on some artificial boomed COVID numbers here, and that the risk is on the downside, as their exposure to the consumer is really substantial, or the majority. Once again, their financial targets at 20. We've gone through all of this, so I will skip this. But the sales growth of 12%, of 30 billion in 20 billion in 2030. That's wrong there. Exactly, 20 billion in 2030. It represents a revenue growth CAGR of about 12% versus 8.3% average CAGR since 2014 in the IPO. What are the arguments for them achieving this goal? More government subsidies, and what's against it, at least in the short term, COVID renovation boom with boosted numbers temporarily. And it will be hard to achieve these growth rates, at least for 2023, perhaps for 2024 as well. Very gloomy here. No payment for 2019 due to the pandemic in regards to their dividends. This shows their capital allocation, and my fear is that they won't be able to pay out a dividend if the market was to go into a downturn, at least it would at least be threaten the dividend and may perhaps not remain on such high levels, because their profits would also go down, and their dividend policy is to give out 50% of net profit. This goes to show just a small case study of their proof of acquisitions. They are very good at identifying efficiencies. So 5 business units were identified with a combined sales of 370 million and an operating EBITDA margin of 7.1. The 5 businesses have today combined sales of 520 million with an operating EBITDA margin of 6.6. So about the same. Derive more this business with negative results. Sorry, negative 7.1. I thought so. That didn't make any sense. So they grew the sales in these 5 businesses, but also made them profitable on an EBITDA basis. Shows that they're very good at the value creation model. Yes, this is a very good slide. So the cost of goods sold, 76% of sales, about 50% of their sales is material, installation, and freight costs. There we can find the gas prices in there. So this is a good graph of showing their cost structure. They have seasonality, where Q1 is the worst quarter for the full year. However, as they say here, they have had less seasonality during the pandemic. I wonder why. As I said recently, I think that their numbers are artificially increased because of easy access to capital during the pandemic when everyone is home and wanting to renovate their homes. Anecdotally, this is what has been the case here in Sweden. Yes, so we can see that the past 2 years, so this 2022 and 2021, the seasonality has been less of an issue. What they do is they're really good at reducing capacity and costs because of the seasonality. They have a good adaptation to the business. They get early signals of this, so they reduce their spending less. So they can forecast that reduction in sales quite early, it seems like. This is at least what the message gives to the message that I get, meaning that how would they know to reduce their costs, or not to reduce their costs as much because of less seasonality? Well, that means that they're able to forecast weaker demand or what so. Lower capex in recent years, and this will increase again. And as my comment suggests, will we increase capex whilst revenues perhaps decrease because of a squeezed consumer? Maybe, I don't know, but it's my gut feeling, looking at the numbers and the markets. So on to their segments. Scandinavia, their largest market, improved margins, as we can see, 2018. But what happened here? We had a pandemic, and margins have been increasing ever since. Eastern Europe is their next largest segment, about a half of their profit margins. 2.3 billion in Swedish kronor in revenues compared to 5 in Scandinavia. And then their e-commerce segment has a lower margin in 2022 because of the reasons that we listed. Absolute nosedive here. And then they have Western Europe. So Scandinavia, Eastern Europe, e-commerce, and Western Europe. These are their segments. So Q3 highlights that I can't spell. I can see highlights. 10th consecutive quarter with organic growth on a high level. Both growth and profitability exceed our long-term financial targets. No wonder. Good development in 3 out of 4 business areas, being Scandinavia, Eastern, Western Europe, and the fourth one being e-commerce that has not performed well. Weaker development for e-commerce, mainly due to lost momentum after supply chain disturbances in H1. Continued increase of glass prices due to high price of natural gas. However, wood prices are starting to soften from high levels. So, as I said earlier, as I indicated earlier, that natural gas is a huge contributor to in producing windows. However, this is a good argument for higher margins in the future as these input prices decrease, but perhaps they can remain some pricing power on the consumer. So that's another argument on the bullish side, I would say. Here's some numbers. You can look at those if you want to. Here I have highlighted 2 interesting things that most business units have adjusted prices in a successful way in order to compensate for input materials and energy prices. Pricing power. For Scandinavia, their order backlog has decreased by 9%. And as I mentioned earlier, is this the sign of the consumer starting to soften? Perhaps. However, when we go into the next one, we can see that Eastern Europe are not facing the same problem because they have grown their backlog by 28%. Interesting here that we have a larger portion being industry than consumer. Maybe that protects INWIDO in some sense. And similar great order backlog for Western Europe, but also here in similarity to the Scandinavian market, a large exposure to the consumer. And one theory that I had is that Eastern and Western Europe, that they have been so successful, or that their order backlog is still very driving on strong growth. Could that be because of greater government subsidies? Maybe. Yes. Higher sales, lower margin due to e-commerce. E-commerce has been a headwind to margins, but great growth otherwise. Meaning that the margin is being suppressed of e-commerce according to them, but their revenue growth compensates for that, so that their overall total EBITDA is still up. Some highlights from their summary and outlook. A strong order backlog supports sales in the near term, but some uncertainty about order intake, as we saw in those Scandinavian numbers now, didn't we? They have a proven track record of rapidly adjusting our operations to fluctuations in volume and remain prepared for any demand development scenario while protecting our margin. And this I have to give them. Yes, I'm very gloomy on the macroeconomic backdrop. However, they, as we saw with the increased demand for 2021 and 2022, the seasonality has diminished, right? 2020 and 2021. Seasonality had diminished, and they did not decrease their spending accordingly. So they've really proven, to me at least, that they are really good at adjusting their operations to maintain profit margins. I listened to their earnings call, and these are two. This is from the transcript. Two things that stood out, or two questions that stood out. What's the margin hit from higher input prices such as glass? Input prices. Henrik Hjalmarsson, the CEO, says that input material prices alone probably impacting the net margin by around 1 percentage point. So perhaps you can see a 10% increase in the margin, meaning 1 percentage point increase. 1 absolute percentage point increase, but 10% relative. Another interesting question I thought was, when do you expect your e-commerce efficiency to be back to normal? And that they expect a gradual supply chain efficiency recovery here during the fourth quarter. So we should definitely see some improved numbers from their e-commerce segment. If not, that's an issue for me. 36 minutes. Okay, their financials. Let's get it. Here we can see from 2012 their revenue and operating income, net income, and subsequent margins, and I also included gross margins. Stable growth, in my opinion, but some seasonality, not always as linear as one would wish. We can see that between 2018, 2019, even 2020, and then all of a sudden boomed up in 2021. And this is the year end 2021, and if 2022 would be here as well, we would see an even greater boom. Perhaps it's not too hard to see the revenues maybe come back towards the 7 billion mark. Maybe, just looking from this graph here. Margins have also expanded quite beautifully. Yes, was that everything I wanted to show here? Yeah, and maybe perhaps now their margin is around an 8. Maybe it wouldn't be too. Sorry, around a 12. Maybe it wouldn't be too. It wouldn't be hard to guess perhaps maybe a margin closer to 8, as these normalized figures would suggest. But also very important to take into consideration that they've implemented acquisitions during this period. So maybe you won't be seeing like 2016 levels where revenue goes down to under 7 billion Swedish crowns, but perhaps somewhere here in the middle, 7 billion. Just in the near term, that wouldn't surprise me. Here we have a good illustration from their cash flow, that in the 2020 and 2021 have an absolute boom in free cash flow margins. Their cash from operations was significant. Very lumpy. I don't see a real. There's no real trend here. We see multiple years where free cash flow margins has been on a very low level, and especially compared to these most recent years where we had a margin of around 16%. Obviously unsustainable, at least according to the trend. They also mentioned that capex will be increasing, so perhaps we will see a decrease in free cash flow here coming. I also wanted to illustrate the free cash flow, which is the pink line, and compare that to net income. and you see how they vary a lot. They're not the same every single year. Taking 2020 as an example, where you have up towards almost a billion in free cash flow, whilst net income was only around 500 million, so half of that. So perhaps net income is a better, as this graph would suggest, a better indication of business performance in the long run. Just a margin overview, quite stable. Operating margins around 8 to 12%, and their free cash flow margin. Just wanted to show that they're quite stable, but do notice that a net income margin of when we're working with such low numbers of 9 or 10 or 12, that is a huge increase to, say, a lower margin of 5. That would halve their profits. As I mentioned earlier, they don't dilute anything, which I wanted to illustrate in this graph. Shares outstanding have been stable over the past decade. Here is their total debt and the net debt, as we can see. Yes. Their balance sheet overview, last 12 months is the most interesting. They have about 9 billion in cash, debt of around, let's go say, current portion 62 million, long-term debt 1.5 billion, capital leases about 300 million. So well capitalized. But if we look at the other previous years, outside of the COVID boom, 2020, 2021, and now 2022, their cash position has been significantly lower, about 20% of what it is at today. I guess 20 to 40%. So they have been working with a higher debt to cash ratio historically. So perhaps we see some mean reversion there, and that spooks markets a bit. I don't know. There's at least that uncertainty. This is quite good illustrating here that they've been working at a higher net debt to EBITDA ratio, and remember that their goal is to be under 2.5, right? And now we're at 0.8, if I don't, maybe 0.6, I don't recall. This ratio can spike up, and that would be scary. I think the market would think so, at least. I don't doubt that this is normal for them, but this number here will probably increase in the future, and I don't see that as beneficial. So over to ownership. As this table suggests, a lot of funds, mainly funds, hold the shares in this company. We do have some individual investors. Eklund-familjen, I have not found too much about them and who they are, but they're not operating within the business as far as I'm concerned, or as far as I know, as far as my research would suggest. Peter Velin, the CFO, as we've mentioned previously, he holds a sizable position at around 15 million kroner. But is it huge? No, not really. Assuming that he makes probably more than no more than 15 million, but probably makes more than 1 million per year. But still sizable position, but no real skin in the game is my conclusion. Oh, this is really poor illustration of or it's hard for you to see here. Maybe I can do this for you. What I wanted to show you here is the price. It's been accumulating anywhere between 55 to 100 ish. This share price is today around 120 million. And sorry, 120 crowns. So the majority of the acquiring has been under 100, one would say. Exception here, we see a couple transactions at 160 crowns. Over to valuation. Historically, in terms of next 12 months numbers, like forward earnings, the mean is 10.8, so around 11. High of 17, low of 6 or 5.9. Last is 10. So just in line with the mean here, assuming that they actually reach the earnings expectations of the next 12 months, which I am doubtful to. Free cash flow is the mean is 13.5, last 12.5, about the same ratio as the PE. EV to EBIT, mean 10.2, last 8.7. Perhaps this is the market pre-pricing in that they will put on more debt onto the balance sheet, maybe, and then increase the enterprise value. Looking at trailing metrics, we have 8.4 PE with the mean, levered free cash flow, with the mean being 17.8, and this is due to their I was going to say lower debt structure, but I'm not too sure if that is the case actually. Or lower low debt at the moment, but maybe that isn't the case. PE mean 17.7, last 8.7, so seems cheap there. And the enterprise value to EBIT 11.9, and last is 7.6. So on trailing metrics, this seems very cheap. But methods that I think are appropriate as to value this company and where I would be interested, I use a dividend discount model, a DCF, discounted cash flow, and 3 scenarios with a bear, base, and bull exit multiple. First off, to the dividend discount model, I am projecting a dividend of 4 crowns per share, going to 4.2, and then 6 in years. In year, vad ska vi säga, 2023, 2024, 2025. And mind you that their dividend this trailing 12 months is 6.5, so I'm forecasting a big drop here, so 7, and then 2024 also being quite tough for them, but to rebound there in 2025, 6.5, and then 7 in year 2028, when I assume an EPS of 15. Their EPS in 2020, or expected EPS, is around 13. This would give a share price out 2028, and for a 15% return, given that my assumptions, conservative assumptions at that, if they turn out, you want to buy this at 92 for a 15% return and an exit multiple of 10. So very conservative here, very conservative. Perhaps one could argue with their prospects that an ESG position that they deserve a multiple of 15. you could make that case, but I want to be conservative in that sense. So exit multiple of 10, 15% return, intrinsic share price of 92. So if you were to buy it there, you could assume 15% return if these assumptions are held true. Given the you buy the shares at 117 crowns. Discounted cash flow. Trailing 12 months is around 900. They have a net debt position of 1 billion Swedish crowns. I forecast next year that will almost half, or at least 40% will dissipate. So 550 million in free cash flow, and then growing that out with 100 million incremental increases year in, year out. Exit multiple of 10, 15 for a 15% return. Intrinsic share price 134. This would imply a margin of safety of 15. I would like a margin of safety of 20 to 30%. 20 to 30%. And that also goes for the dividend discount model. So I would want to buy this under 90, perhaps closer to 80, according to this model here. This model gives me a higher share price. And then the last one. Oh yeah, my comment here. This is not giving them credit for the recent bump in free cash flow, as we could see previously. That their free cash flow has been extremely high with astronomical margins, free cash flow margins. And remember that they have themselves cited that capex will be increasing years coming forward. Exit multiple, I am in year 2028, the revenue of 12 billion. Their trailing revenue, I forgot, is around 9 billion, I think. Yeah, so about 3 billion growth there 5 years out. EBIT margin of 6, which gives them 720 million. Tax rate of 27% gives them an earnings of 525 million crowns. Multiple of 8 gives the market cap of 420 million. You have to take in consideration their debt and reduce that from add that to the position. I've done that wrong here because they are a net debt position. Just that. Scheisse. I've done this wrong here. This enterprise value should be a little bit higher. Whatever. If this turns out, you will be screwed. This is worst case scenario, assuming that perhaps that they're relentless to drive growth through acquisition and their margins take hit. This has historically not been the case, but that could happen. Oh yeah, very important to take into consideration that their historical EBIT margins have been around 8 to 11.5%. So for the base case, I'm assuming 9% EBIT margins. Remember that the historical has been around 8 to 11.5. Assuming 10 exit multiple, it gives me a market cap of around 10 billion. Luckily, the debt is the debt position isn't too large, so these numbers shouldn't change too much. So X upside 2028 is about 1.2 times, which gives a CAGR of 4% over that time period.
Jag förstod tyvärr inte.
No, Google doesn't understand, and neither did I. Also, that's assuming revenue of 16 billion Swedish crowns. Take into the consideration that their targets for 2030, 2 years after this forecast, are 20 billion. So if the base case turns out, then they are way off their goals there. They would have to grow quite rapidly in the last 2 years to reach that target. Bull case, which maybe is in line with their own expectations, the company's own expectations, revenue of 18 billion, EBIT margin of 11, so around peak margins, gives EBIT of close to 2 billion. Same process as earlier, we get a CAGR of, or X upside of 2.84 times. That would give a CAGR of 23%. So every single year, your money would compound at that rate. And this is not including dividends. No dividends taken into consideration here. So what I want to show with this is that if their targets that they have communicated with the market, if those turn out, this could be a great, amazing investment. And quite frankly, long term, I think that this will turn out. They have good prospects. They have a good product. They're riding the ESG wave. Government subsidies coming in. However, in the near term, I think that the consumer will be squeezed, and the business will take a hit as a result of that. I do think so, yeah. So, risks. The consumer, interest rates, inflation, leading to less building. The consumer will be paying a higher proportion of their income to interest rates, which lost money. Inflation, their other other products and the services that they consume, this will increase, and they will have to decrease costs somewhere else. I don't think that people want to renovate their homes in a time of financial distress. I don't see that being the case. Further risks are increased debt, as we spoke about earlier. If they're to revert to the mean there, they will increase their debt. Also, in the scenario where they increase capex and reduce free cash flow, this could scare the markets. Last risk that I can identify is their lack of execution. They have a goal of ramping up their M&A. M&A is always complicated and could be harmful to the shareholder if not their previous performance remains of multiple arbitrage, synergy captures. Synergy captures. Basically those multiple arbitrage and synergy captures, improving margins in that sense. Summary. I think this is a wonderful business. Absolutely fantastic. Proven track record. Love the business model. It's a win-win-win. The company wins in terms of product, selling their wins in terms of profits and when selling their products. The consumer gets less expenses in terms of energy. Remember that about a third can be saved from proper isolated windows and doors. And lastly, governments want the consumers for this to be fulfilled, right? Hence the government subsidies to reduce demand for energy. It's energy efficient in this sense. They are market leaders in the Nordics, with potential to consolidate the European markets. At least so far, they've been doing a really good job. However, these recent tailwinds, with the pandemic boom, everyone is renovating. They might have bumped up financials unsustainably for the time being. They also have a low insider ownership, not a lot of skin in the game. Hjalmar, the CEO, would not see his stock portfolio plummet if these risks materialize. I am interested, as my valuation metrics would suggest, at 80 to 90 crowns per share. I think I will start accumulating there. Maybe I fall in love a bit too much with the business and will accumulating under 100. But intellectually at 80 to 90 crowns a share. Ooh, my voice hurts. This has just crossed the hour mark. Thank you so much for listening and watching, and it took a lot of time to conduct these slides and videos and research. I hope you enjoyed. I definitely did. It's been a great process. Okay, take care.